Hi, I'm Roger Montgomery from the Montgomery Fund and welcome to this week's video insight. We know only too well that in the short run the stock market's a voting machine, a popularity contest if you will. And in the last week or two we've witnessed some dramatic volatility in the short term. This week I'd like to address some of the questions raised by this volatility. First and foremost, keep in mind when the price of something falls from $10 to $3 and subsequently jumps to $4, the last move represents a 33% increase, but the shares are still 60% lower than where they were at $10. The point is that you shouldn't be led by price changes. Clearly, they can lead you astray. Now, to the source of all this recent volatility, Mr. Ben Bernanke. Back on Wednesday, June 19, the US Central Bank's chairman said that if the economy and job market continue to improve, a gradual tapering of the bond purchases, quantitative easing, could begin later this year, with continued reductions next year until they stop in mid-2014, assuming the unemployment rate falls to about 7%. It's currently about 7.6%. Predictably, investors ignored 2014 and sent stocks tumbling immediately. The Dow Jones on the day dropped 1.4%, as did the S&P 500, and more importantly, 10-year bond yields rose to their 15-month highs. But in an example of what appears to me to demonstrate disharmony at the Fed, if not its increasing irrelevance, Ben Bernanke's offsiders last week tried to reverse all the damage caused by Bernanke's earlier statements. Importantly, the genie is out of the bag. Quantitative easing will end, but the message is not yet. More importantly, investors should really reflect on how much of what is said by the Fed can be regarded as really useful. Back in March 2006, 18 months before the start of the GFC, Bernanke, in his first meeting as Fed chairman, noted the slowdown in the housing market. But he said, and I quote, "Strong fundamentals support a relatively soft landing in housing," adding, quote, "I think we're unlikely to see growth being derailed by the housing market," end quote. You can see the timing of this statement on this chart. In December 2006, Bernanke's equivalent at the New York Fed, Tim Geithner, said, quote, "We think the fundamentals of the expansion going forward still look good." And history has shown that to be completely wrong. The point is, I guess, that it's clear that volatility in the market and the threat to your returns in the short term come from the musings and prognostications of a bunch of people whose track record is anything but accurate. More importantly, however, you need to be aware that we believe quantitative easing is likely to continue for some time. But just as confidence about this returns, the risk of asset bubbles rises and will be met with the knowledge that quantitative easing will end. So be careful of that, and as an Australian investor, you really need to be thinking about the worsening investment picture, the deteriorating growth in China, and the serious risks emerging from policies there that are designed to curtail credit growth. More importantly, when we look at Australian stocks, we believe that they are no longer cheap. And we're worried that you may blindly follow the changes in share prices spurred by what's going on in the United States. That's my thought for this week. I look forward to seeing you again next week with another insight. And be sure to follow us on Facebook and Twitter.